Hi there, this is David Hillier here, and I'm going to give you a video on long-term financing, but I'm going to focus on ordinary shares. And the title I've given to this particular video is Tell Me About Ordinary Shares. So this is really a descriptive video, one to really just find out, well, okay, what do we actually mean by an ordinary share? We talk about equity, and equity is that ownership stake that investors have in a company. So what is an ordinary share? Well, an ordinary share is an example of equity. And it's probably the most common example of what we define as equity. It's a type of equity. It's also known as common stock as well. Or you might even hear the term ordinary equity, ordinary shares. So all these terms are interchangeable. You tend to see common stock used in the US, and ordinary shares, ordinary equity used in the UK and Europe. Other parts of the world, it really depends on the convention. So let's start off, and I think probably the best example is to look at just an actual company itself. So I've got the FT here. You can see that in times we've had a really bad, shocking situation in Barcelona, but let's focus on, for now, the markets, and I'm going to click on markets data. Right, so if you look at the markets data, and I'm just looking at the way in which all the indices are moving, this isn't a good day for the markets. All the markets are in red territory. I'm going to click on FTSE 100, so let's click on here, and this is a FTSE 100 index. So that's the largest British companies, and we'll click on constituents, and we'll try and find, as you can see, nearly every single company is in bear territory. If we get any positives, we've got this one here. That's Mondi PLC. So let's click on Mondi PLC, and we're going to look at the financials. So the company's done well today. Probably the only one that's gone up, and over the year it's gone up by about 30%. It's a company that's based in forestry and paper. Probably it's got a lot of exports, but let's not go into the company so much. I want to go into the financials and look at the balance sheet of the company. And under the balance sheet, I want to go right down to shareholder equity. So let's just have a look at Mondi PLC and identify, okay, let's look at the different parts of this. So this is the FT, and you'll see that the first line under shareholder equity is common stock. And common stock, as I've said, is also ordinary shares, ordinary equity. So look on that as the main share class that the company has, and you'll see that it hasn't changed for over the last few years, 2012 all the way to 2016. So that is that effectively is no change whatsoever. Now that's quite interesting, because you might say, well, how does that happen? Because surely if the share price goes up or go down, the value of the equity changes. Well, remember, this is an accounting statement. And that accounting statement, the value of the equity goes right all the way back to when maybe the company was even started. And we are going to talk about that in a little minute, in terms of the different types of equity, in terms of the equity characteristics. But for just now, just notice that according to the accounting statement, the value of the equity has not changed. And we call that the book value of the equity, and the book value of the common stock. If you then go into the next part, and that's additional paid-in capital. Now, what does that mean? Well, now this might just seem completely pointless, but when you talk about ordinary shares, you can talk about par value. And what does par value mean? Well, par value is, if you think about when a company goes from being private to being public, they have to have the articles of incorporation. And when you look at the articles of incorporation, it might have been when you first started up the company, 3 shareholders, and each shareholder has 5 shares, and each of those 5 shares have a value of £1 each. And you just make that up because the company's private. You're just looking at getting these share values together, and that could be tied into how much you invest, but it could also just be a value that you come up with. Now, that par value that we talk about is the original value that you've put into to say that each share is worth. So it goes back to when a company's private, not public. Now, over time, once the company has become public, which is what we've got with Mondi here and any other company that's been listed in a stock exchange, that company might have another share issue. And there's a difference between the market value, the share price, and the original price that was written into the certificate. So let's say that the par value, that was the original price in the certificate, was £1. But because the company's clearly increased in value, that the issue price would have been, say, £10. So how do you incorporate that difference between the original value of the pound in shares, but then when you issue these shares to the market, you're issuing them at £10? But what you do is you say, well, the share capital increases. It increases by £1 per value plus £9 additional paid in capital. So the additional paid in capital part is I suppose the difference in the value of the shares from what they originally were stated as and what they've been issued in the market. If you add the par value plus the additional share paid in capital, £1 plus £9, it becomes the issue price. So that's why you see this term additional paid in capital. Now, for this company, they haven't got any additional paid in capital, so they effectively haven't had a big share issue from the time that they actually initially launched the company. So that's just a term. It's par value versus no par value. And this actually might have been that the company, when it was listed on the stock exchange, it basically got rid of the idea of par value and just went straight in with a no par value. What is the share price? That's it, and that's what they've gone in with at the issue date. You need to go into that in more detail to find that out. Now, moving into retained earnings, or if it's in brackets, accumulated deficit. Now, what's that value? Now, you can see the majority of this company's equity is made up of retained earnings. If you think about a company, every year the company will have its operations and it'll either make a profit or it'll make a loss. Now, out of that profit, we call that, the earnings. It will take some of those earnings and pay a part of those earnings out in the form of dividends. Now, it might be 100% of the income, and if it's 100% of the income, then all of the earnings are paid out as dividend, and you don't retain anything. But if you are only paying a small amount of your earnings year on year out as dividends, then you're going to be retaining some of that. And that then goes into the balance sheet as retained earnings. If you do that year on year, you're going to accumulate the retained earnings. And so you see here that retained earnings are going up year on year for this particular company. And that then adds to the overall shareholder equity. If we look at treasury stock, now you might say, well, what's treasury stock? Treasury stock is when the company buys shares back from shareholders. So it's the company that buys those shares back. So they've bought those shares back. It reduces the amount of shares that are in circulation. So therefore, it will show as a negative. So that's just telling you that, let's just see what it's in millions of euros. So 24 million euros of shares have been bought back in 2013. Something happened in 2015, but you can see here that it's still 24 million. Unrealised gain or losses is a term, again, it's an accounting term, if there's been an increase in the value that's been recognised in the accounts as an increase in the value of the equity, but it's not been realised by the company, then that would appear there. And then you have other equity. Now, other equity might be, could do it can be a number of things. It could be different share classes. It could be hybrid securities. That's just under a catch-all. I don't have the information here to see what that is about. So I would then go into the notes to the accounts to find out what that was all about, and read into that in more detail. So that's a total, I suppose, a description of the different types of equity. And you see that ordinary shares or common stock is just one part of that, and you can see that in this set of accounts. Okay, so that's the I suppose an overview of the different share characteristics, and we're just going to go through each of these. So the first one, par versus no par shares. So I've already spoken about that. That's tied to when a company was a private firm and when it goes from being private to being listed. You have authorised versus outstanding shares. So a company will want to issue new shares in the market, and it will get authorisation for a certain amount, but that amount that gets authorisation to issue, that's the total amount, and the management of the company will say, well, we don't need all of that just now, we only need a portion of that. So they only issue a fraction of the authorised share capital, and that fraction that they issue is known as outstanding shares. And this allows the management to go back at maybe 6 months from now or a year from now to issue more shares if they need to raise the capital. So it's a way to basically reduce the amount of bureaucracy and admin that they have to go through in terms of going for new share issues. I've spoken about retained earnings. Market values to book values. So let's go back to our Monday example, and you'll see that the total book value of equity at the moment is it's in millions of euros. So it's 3.392 billion euros. That's the value on the accounting statement, the book value. Let's look at the value on the market. So if we just let this load up, the value of the market is 9.76 billion euros. So you see a difference between what the accounting statement says, which is 3 billion euros, and what the market says, and that market is the price multiplied by the number of shares outstanding. So it's like 3 times the value, and that really represents the growth opportunities that are available to this particular company. So it's got a really high market to book value ratio, and that's something that is quite I suppose unique for this particular company. Moving on, shareholders' rights. Let's talk about shareholders' rights. What are they? If you're a shareholder of a company, you have rights because you're an owner of the company. An ordinary shareholder is an owner of the assets of the company. And if you think, what are the rights of an owner? If you think about a football, with a football, you have a right to choose what to do with that football because it's yours. You have a right to sell the football. It's up to you. You have a right to, I suppose, decide what other people are doing with that football. You have a right to benefit from owning that football. For example, you might be allowed to play some football matches even though you might be completely rubbish. You might be able to, and I suppose the last one is a bit weird. It's you might be able to, in a sense, sell parts of the football, ownership of the football. So let's say you've got 4 people who want to use the football. You can sell some of that football to other people. So that's a kind of rubbishy example. When you're doing a video, sometimes you come up with these. But if you then apply that to what it means to be a shareholder, then it's just ownership rights. So you have the right to share proportionally in any of the cash that comes out of the company through dividends. You have the right to share in any value that's retained, or any cash flows that come from selling the assets if the company goes into liquidation. You have the right to vote at an annual general meeting, and particularly if there's really big things that's going to happen to the company, like a merger, you have the right to decide whether you want to go ahead with that or not. And you also have the right to buy into the company in the future if a company decides to raise money in the markets. We call that a preemptive right. And I'll have a whole video on that in a later date. We can also talk about dividends. Well, what's a dividend then in the context of ordinary shares? Well, first thing is it's a distribution of cash from the company to the shareholders. Now, it's up to the company if they want to give that to the shareholders, because the shareholder can get a return either from an increase in the value of the shares or through the cash that comes out from the company. They're completely voluntary, so a company isn't obligated to issue dividends. It's up to the company itself. And so it's not a liability then. If they were obligated to issue these dividends every year, then it would be a liability. But for an ordinary share, it's you don't need to issue dividends if you don't want to. And given that that's the case, it's not like a debt instrument. You can't default on a missing dividend. If a company decides after 10 years that it's not going to issue a dividend, that's fine. You can't do anything about it. It's also not an expense. You distribute the dividends after all the expenses and tax have been taken off, and it comes really from what we call the bottom line or the net income, and you decide how you want to use that. Do you want to retain the income, the earnings, and that's retained earnings, or do you want to pay it out in the form of dividends? And for the shareholders, they tend to be treated as income tax. Or income, ordinary income for tax purposes. Although you have to really look at each country to look at the actual details of that, because each country is different in the way that it treats dividends. So that's me in terms of just going through each of the different characteristics. The last one is classes of shares. Companies can have different classes of shares. And they'll have either maybe different voting rights or different characteristics, and we'll talk about that in more detail in later lectures. So I hope you've enjoyed this very quick tour of what it means to have an ordinary share, and I look forward to seeing you again in future weeks. Bye.